After studying this module, you shall be able to know about the global or the international capital markets, understand the development and the growth of the international bond markets, the different type of international bonds, their variants and the procedures to issue international bonds, understand the development of the international stock market, know the reasons responsible for its growth and the procedure to issue international equity, appreciate the growth of the international banking, know about the various modes of the internationalization and the factors responsible for the growth of international bank. Introduction. With the globalization, several companies have expanded their operation across borders, which have led to the growth of the global capital markets. Development and improvements in the technology have facilitated the movement of the capital around the world, enabling the investors to buy and hold stocks in the multiple currencies. International or global capital markets. The international capital markets serve as a link between the capital markets of the individual countries. The international capital markets have enabled the companies to raise capital, whether debt or equity, in multiple currencies with maturity periods varying from 1 month to 30 years. The international capital market has broadly two segments, namely international or global bond market. Second, international or global stock market. International bond markets. The international bond market is a market where foreign currency bonds, both government and corporate bonds, are issued and traded across countries. The major reason responsible for the emergence and the development of the international bond market is the difference in the tax laws between the countries. It was in 1950s when the international bonds spurred on the significant scale. Yankee bonds were the most common and popular bonds at that time. These were the dollar-denominated bonds sold in the US markets by the issuers belonging to the countries other than the US. In 1960s, the SEC, Security Exchange Commission of US, started imposing strict regulations on these bonds, which paved the way for the birth of the Euro bonds. In the last decade, the international bond market has almost doubled in its size due to the growth and the spread of the multinational companies. Major types of the international bonds. It refers to a bond offered by a foreign entity to investors in the domestic market which is denominated in that country's domestic currency. Foreign bonds are lucrative for the investors because they get to diversify their portfolio by addition of foreign content without having to deal with the exchange rate risk. These bonds are regulated by authorities of economy in which they are issued and are generally given names according to the national market in which they are issued. For example, bulldog bonds are pound dominated bonds issued in United Kingdom by a foreign company. Similarly, samurai bonds are yen dominated bonds issued in Japan by the foreign companies. Euro bonds. A euro bond is a bond denominated in the currency other than that of the country in which it is issued. A French company selling a dollar denominated euro bond in Japan is an example of euro bond. Euro bond account for around 80% of the bonds issued in the international bond market. The first euro bond was issued in 1963 by an Italian company, Autostrade. Major differences between foreign and the euro bonds. Denomination. Foreign bonds are denominated in the currency of the country in which the bonds are issued, whereas euro bonds are denominated in the currency other than that of the country in which they are issued. Regulation. Foreign bonds are regulated by the authorities of the country in which they are issued, whereas euro bonds are not governed by the rules and regulations of the country in which they are issued. Global bonds. The concept of the global bonds was created by the World Bank, and it was the first issuer of the global bonds in 1989. These bonds can be issued simultaneously in several countries. Global bonds are more flexible as they can be offered in a country in whose currency it is denominated as well as in the other countries. These are generally issued by the large multinationals which have high credit rating. Cocktail bonds. Cocktail bonds are the ones which are denominated in multiple currency or basket of currencies such as SDRs, special drawing rights, or ECUs, European Currency Unit. This type of bond provides currency diversification benefits to its investors. Some variants of the bonds. Straight bonds. The interest rate, also known as coupon rate, is fixed in case of straight bonds. That is, investors are paid regular and fixed interest payment during the life of the bond. These bonds have specified maturity date on which the principal amount is returned. Floating rate bonds, also known as floating rate notes or floaters. These bonds do not carry any fixed interest rates. Rather, the interest rate is tied to some reference rate such as LIBOR, London Interbank Offered Rate. The interest payment are generally paid quarterly or semi-annually. These bonds were issued for the first time in Italy in 1970s. Zero coupon bonds. In case of zero coupon bonds, no interest is payable over the life of the bonds. These bonds are sold at the significant discount from the face value, and at the maturity, the investor gets the full face value. Dual currency bond. A dual currency bond is one which is issued in one currency and the interest at a fixed rate is also paid in the same currency, say pounds. However, the principal amount is paid in some other currency, say dollars. Convertible bonds. In case of convertible bonds, investor has an option to convert the bond into the fixed number of shares at the predetermined price and the time. Procedure to issue bonds in international market. Step 1. The issuer of the bond approaches a commercial bank or the investment bank and it asks to act as a lead manager and advise it on the various aspects involved in the issue process. The lead manager is selected after a careful analysis of the performance of various investment banks. The lead manager then advises the issuer on the price, timings, size and the maturity of the issue suitable for the indicators prevailing in the international bond market. In return for the advisory services, the lead manager charges a fee which is known as a management fee. Step 2. After the advice from the lead manager, the issuer with the help of his accountant, legal consultant, auditor and others prepare the prospectus and other legal documents. After the preparation of the necessary documents, the issuer obtains the approval from the regulatory authorities. After the receipt of the approval, the issue is launched. Step 3. The lead manager helps the issuer to get credit rating from a well-recognized credit rating institution and also functions as the underwriter of the issue for which it charges the underwriting fee. Step 4. This is the stage where the sales of the bond begins. Generally, the lead manager acts as a selling group and sells the bond to the investors in return for the commission. The issuer also appoints the trustee who has duty to protect the interest of the investors, especially in case of default by the borrower. Sometimes the lead manager acts as a trustee. International stock markets. The international stock or the equity markets provide the platform to the companies to get their stock listed and traded on the foreign stock exchanges like London or New York Stock Exchange NYSE. For example, Indian companies like ICICI Bank, Wipro and Tata Motors have got their stock listed on New York Stock Exchange. International stock markets enable the firm to mobilize funds from international investors. Investors, in return, get the opportunity to diversify their portfolios by adding foreign content to it and also to improve the return on their portfolios. Many a times, company issues stock in the foreign markets to evade the regulation in the domestic market. Since rule and regulations differ across markets, the international integration of the equity markets have led to the emergence of the concept of the cross listing, that is, listing of the stock in the national stock exchange as well as one or more foreign stock exchange. There are several benefits that the company gets by getting its stock listed on the foreign exchange, like the investor base gets expanded and helps to increase the market price of the stock. The company gets recognized worldwide and more people become familiar with the company, which in turn leads to the increased demand and increased sales of the company's products. The market standing of the company also improves when the company gets the approval for the listing by the foreign stock exchange. As the ownership gets dispersed, the chances of hostile takeover are minimized as it becomes difficult for the firms to gain controlling interest. Procedure to issue international equity. Step 1. The company that wants to issue international equity first approaches a lead manager, generally an investment bank. The lead manager, after examining the prospects and the risk involved in the international market, advises the company about the size, price and the market where the equity is to be issued. The issuer then prepares the prospectus and other necessary documents and also takes the necessary approvals from the regulatory authorities. Step 2. The company then approaches an international depository in whose name the shares are issued. The depository is the bank or the financial institution situated in the international market and serves as a link between the issuer and the investors. Step 3. The depository appoints a custodian bank in consultation with the issuing company. The custodian bank holds the share on the behalf of the depository and is located in issuing company's domestic country. After obtaining the approval from the regulatory authorities, the issuing company deposits the shares with the custodian bank. Step 4. The custodian bank then informs the depository of the receipt of the shares and asks the latter to issue the depository receipts in lieu of the shares held. The depository receipts are the instruments issued by the depositories and they represent an interest in the underlying share held by the depository in the issuing company. There are broadly two types of depository receipts, namely the ADRs and GDRs. ADRs, American Depository Receipt. The depository receipt that are listed and traded in US stock markets are called ADRs. GDRs, Global Depository Receipts. The depository receipts that are listed and traded in the market other than the US are called GDRs. Step 5. The depository then issues the depository receipts. Once the depository receipts are purchased by the investors, the proceeds from the issue flow from the depository to the custodian bank and from the custodian bank to the issuing company. Factors which have contributed to the internalization of the stock markets. The various factors which are responsible for the significant growth of the international stock markets are removal of the restrictions on the flow of capital from one nation to another, particularly by the emerging economies. Awareness among the investors of the benefits of the diversification of the portfolio investments associated with the adding foreign content to it. The evolution in the technology that has enabled the companies and the investors to conduct transaction across borders more effectively and efficiently. Recognition of the benefits associated with the issuing equity in the international markets by the companies. Now we are going to learn international banking. International banking. The cross-border flow of funds have been greatly facilitated by the growth of the international banking. International bank is one which accepts deposits in the foreign currencies, extend financial assistance to the multinational companies and provide ancillary services and operates internationally. International banks often form international loan syndicates whereby a group of banks come together and agree to lend a large amount of funds to MNEs or governments. Many of these international banks also provide services like advisory services, merchant banking services, consultancy services and international cash management services. The example of international banks include Industrial and Commercial Bank of China, HSBC Holdings, JP Morgan Chase and Company, Citigroup, Bank of America, Standard Chartered, UBS, Barclays and Morgan Stanley. Now we are going to learn reasons for the growth of the international banks. The emergence of the multinational companies is the prime reason responsible for the growth of the global banking. The banks establish branches abroad in order to continue to provide bank services to the clients when they move abroad. The growth and the liberalization of the trade is also an important driver of the growth of the international banks. The international banks provide a host of services to facilitate the trade between the countries. The virtually unregulated international banks are able to operate with a lower spread as compared to the domestic banks, which is a major factor that attracts the bank to operate internationally. The spread is the difference between the borrowing and the lending rate. These banks offer higher rates on the deposits and provide funds at the lower rates. Many a times, banks move abroad in order to bypass reserve requirements, taxes, reporting requirements and other such regulations. The banks can also take the benefit of the low tax locations. Now we are going to understand modes of internationalization. Correspondent banks. It is the arrangement under which a bank located in the host country provides services to a client on the behalf of the another bank. Many times, banks maintain correspondent relationships with the bank in the countries where they do not have offices of their own. Under this system, banks provide banking services to each other's clients. This mode is the most ideal, especially when the volume of the business is small. By using this mode, the bank can also avoid the establishment costs. Representative offices. A representative office is often established to facilitate the services supplied to the client under correspondent banking system. Under this system, the bank opens up a small office overseas, staffed by the parent bank's personnel. This office then facilitates the dealings between the correspondent bank and the foreign clients of the parent bank. It cannot provide the services itself, that is, it can neither accept deposits nor it can give loans. Foreign branches. This is the most popular form of the international banking and is the most ideal when the volume of the business is large. Foreign branches are subject to the regulations of both the home and the host country, and the parent unit has full control over the operations of the foreign branches. Thus, a foreign branch is a part of the parent bank which is incorporated elsewhere. Subsidiaries and affiliates. A foreign subsidiary bank is one which is locally incorporated and is either partially or wholly owned by the foreign parent. Even if the foreign ownership is partial, the foreign subsidiary is controlled by the foreign parent. On the other hand, an affiliate bank is one which is only partially owned and not controlled by the foreign parent. Consortium bank. It represents joint venture of the large commercial banks whereby several banks from the multiple countries come together to lend large sum of money to large corporations and sometimes governments. This consortium bank is established as a separate entity and is jointly owned by all the partners. Let us summarize now. With globalization, several companies have expanded their operations across borders, which have led to the growth of the global capital markets. International capital market serves as a link between the capital markets of the individual countries. International bond market is a market where the foreign currency bonds are issued and traded across countries. In the last decade, the international bond market has almost doubled in its size due to the growth and the spread of the multinational companies. The major type of international bonds are foreign bonds, euro bonds, global bonds and cocktail bonds. The variants of these bonds include straight bond, floating rate bond, zero coupon bond, dual currency bond and convertible bonds. International stock or equity market provide the platform to the companies to get their stock listed and traded on the foreign stock exchange like London or New York Stock Exchange. They enable the firms to mobilize funds from international investors. Investors in turn get the opportunity to diversify their portfolio by adding foreign content to it and also to improve the returns on their portfolios. Issuing international equity offers several benefits to the firm like expanded customer base, worldwide recognition, increased demand of the product, improved market standing and so on. The growth of the international stock market can be attributed to a number of factors like removal of restrictions on the flow of capital, portfolio diversification benefits and the development in the technology and so on. International bank is one which accepts deposit in the foreign currencies, extend financial assistance to multinational companies and provides ancillary services and operates internationally. The cross-border flow of funds have been directly facilitated by the growth of the international banking. The various factors which have driven the growth of the international banks are growth of multinational companies, international trade, absence of the regulation in the international banking, etc. The various modes of internationalization are correspondent banking, representative offices, foreign branches, foreign subsidiaries and affiliates and consortium banks.